Hello, I'm Electra Frost from Digital Playhouse, and this is an Accountants on Chain webinar where we're a bunch of accountants who are just trying to learn everything about Web3 so that we can service businesses transforming and startups in this space. And one thing we love to do is to learn about the tooling out there and learn on the tools. So today we have Pat White from Bitwave, which is, I think, the first or one of the first solutions for accountants and businesses getting their books in order in crypto. Goes a long way back. They've seen a lot of changes and worked out a lot of good processes as well. So we're really interested in processes, getting on the front foot with businesses that are, doing things properly. So we don't have the shoebox of receipts problem all over again, like on the blockchain. It can get messy really fast. So we're learning as much as we can before here in Australia, the whole wave of crypto business is upon us. So just before we get started and before I introduce Pat, this is just a bit about Digital Playhouse. So we're a registered charity in Queensland with a regional focus, but hey, we're bringing the local global and vice versa. And so these are our three main projects that we're building out. The School of Bitcoin, where you can get off zero, learn the basics about, Bitcoin, where it all started and the technology that's come out of it. And Stacks Australia. Stacks is a blockchain which is scaling on Bitcoin, so in its consensus mechanism. So we need more builders in the blockchain space, and that's where people are learning clarity coding and how to be master stacks and be developers or get their startups going. So we're providing a bit of an incubator accelerator for that. And also accountants on chain, because accountants really need to know about blockchain and they need to support businesses to be successful in this space. So the three projects, the three founders, we're working together to have a solution across the social spectrum for Web3 blockchain adoption. And so thank you very much for being here on your Tuesday morning in Australia. And there'll be good things coming in the new year with Accountants on Chain that I hope you'll be part of. And now the disclaimer, I like to say, if I said it, I didn't say it. These sessions are all about inspiring your curiosity and bringing some awareness so that you can work out your own journey in blockchain, because you can't learn everything at once, but I just want to show you things, share my knowledge, and hope you'll do the same. So always, I don't know if you'll get specific research, specific advice in this area, but you can always do your own research and figure it out for yourself. Get hands-on and learn. That's kind of what we do. All right, so now I'm going to introduce Pat White. Pat, can you unmute yourself, please?
Of course, thank you. Great intro. That was so much fun. This is great.
Yeah, I'm learning to do it off the cuff. I was really nervous when I started doing these because I'm not like, this isn't my natural thing. I'm an accountant nerd, but I think it's really important that my colleagues and I get to know what's going on in the rest of the world. And because there's all this great tooling being built out for crypto, and we've been really struggling with our clients that have been starting to take it on. We haven't seen a lot of business with crypto in Australia yet, mostly just tax returns. But I think it's going to really hit us next year. And
especially where you are. I mean, up in the Gold Coast, the Bitcoin City and everything's been going on there. You can't go a day on a Reddit without seeing someone buying coffee in the area and all that kind of stuff. And that's all the business and accounting use case right there. And I love it. It just makes me so happy. I haven't had a chance to make it down there. I really want to, but it is really cool.
Oh, we'd love to see you. And look, I wonder if some of our clients are using crypto in their businesses, but not telling us. So, we're going to learn some of the lingo from you to start these conversations with our clients, I think. So, please tell me, we're curious, how did you get into crypto and start Bitwave? What's your story?
Yeah, it's a great story. I mean, honestly, my entree into Bitcoin, into crypto in general, was a very long time ago. Like I got, I don't know, I think I got the Satoshi white paper delivered. I was in software security. So I actually worked for a startup in the security space, and I was a product manager. So I was in all these like mailing lists, and I think I actually got the Satoshi white paper delivered to my inbox, whatever it was, 2008. It was exactly 14 years ago yesterday, 2008, that he sent it out to one of the sort of security hacking mailing lists. And immediately it was just, I'm a computer scientist, so immediately for me it was really compelling. Like, it's a really clever solution to a really hard computer science problem, which I know this doesn't really matter to everybody, but the problem that blockchain solves is, how do you get people that hate each other or don't trust each other to work together effectively? And it's a really hard computer science problem. And that was like the genius thing. Like, if Satoshi could get a Nobel Prize, I don't think they give them out to pseudonyms that don't exist, that might be the NSA, but maybe that would be like, there is like a Nobel Prize to be won for what he did around it. There's probably going to be a few Nobel Prizes over the years around crypto. But anyways, it was super interesting really early on. I loved it. I did a little bit of mining. I always tell the story because I mined, back in the day, I probably mined 40 Bitcoin or something. Used it all to pay my rent 1 month, the entire thing. Like, I literally paid my rent 1 month entirely in Bitcoin. Which is, in retrospect, what is that, like a $700,000 Bitcoin rent? But at the time, it kept me from getting evicted. So I guess that was probably better than nothing.
Well, that's it. The value of Bitcoin is what you can do with it at the time.
Exactly. Yep. There's got to be like, there's that guy who sold the pizzas. There's got to be an equivalent of that for the person who paid their rent. Maybe I should like go and look at the day I did that, and like what it be worth now. It's crazy. Anyways, that's when I got into it. But it was really fun. Back then, there wasn't a startup I'm an enterprise software guy. Like, I love building software for businesses and for enterprises. In 2008, 2009, 2010, there wasn't enterprise software to be built here. It was hobbyists. You could have started I could have started like a custodian. That was one of the businesses that was out there. But for people that were around back then, like, one of the first custodians that ever got started was a group called Zappo, that literally they bought a bunker in Switzerland in a mountain, and they had like airlocks and guys with guns. And it like, what we thought custodianship would look like back then to what it looks like today is such a drastically different world. That, like, back then, saying you want to start a custodian was saying like you wanted to recruit a private army and buy a bunker somewhere to save your Bitcoin, which is just not something that really appealed to me personally. I've worked a lot of my life to stay away from guys with guns and things like that. So ended up putting a pin in it. My co-founder and we started another company, came back to it 2017. We looked around, and like, lo and behold, businesses were using crypto. And so we sort of sat down and said, all right, well, what problems are businesses going to have around digital assets? And that was the impetus for Bitwave, and that still to this day is our vision. We are enabling digital assets for enterprises and businesses, and really whatever that takes, from payment operations, accounting and tax, which is what we're going to talk about today, through payment operations, more sophisticated data product, all that kind of stuff is part of how we think about this. And the rest is history. So now we've been around for like almost four or 5 years at this point. So it's crazy.
Fantastic. And I saw that you're on at the New Orleans ZeroCon this year. So you've made Zero app partner, and would be getting a few curious hits now. How did that go? At the ZeroCon?
ZeroCon was great. It was a good show. Lots of people showing curiosity. I mean, part of why we got interested in Zero, to be honest, I think that the world kind of divides between QuickBooks and Zero. QuickBooks really owns the US market.
In Australia, we're very Zero oriented.
Here, Australia, Zero. LATAM, a lot of like Eastern Europe, a lot of developing like countries. Not to say Australia is a developing country. Our friends down under. But for me, when I think about some of the crazy use cases for crypto, I do think about Venezuela. I do think about El Salvador. I think about these developing countries, and Zero tends to have a much bigger presence in those areas. So we work with Zero, QuickBooks, NetSuite, Sage, but I love the Zero ecosystem because it is people that are genuinely looking at spending crypto. Like in where you are in the Gold Coast, there are people like I was saying this before we started. You see every day on Reddit, you see there's someone who posts a video of buying coffee with Bitcoin Cash in Queensland somewhere, and that's like it's the vision for all this. And it gets into like Venezuela and how they're moving to having it as like reserve currency, all that kind of stuff. So I love the Zero market, and it's one of the ones that's going to be incredibly important over time, because it's really where people are going to be actually transacting in crypto which is also where crypto gets really hard to do accounting for, of course.
Well, this will be really interesting to accountants on chain who are mostly digital accountants, or use Xero and some QuickBooks, but are used to building app stack solutions or advising on app stack solutions for their clients, and seeing how solutions like Bitwave fit into it will be very interesting.
That's certainly how we approach it, is that if you're a client, if you're a CPA who does this, we sort of think of ourselves as part of that stack you're going to bring. You're going to bring Xero, you're going to bring Bill.com, who just renamed to Bill, by the way, which is I'm still trying to get over that one. So you're going to bring Bill to the party, as long as Bill's a nice guy. And then you'll have, you'll have Bitwave on top of it. So if you're clients that need digital assets, you'll have Bitwave to basically deploy right there. And that's certainly how we think of it as a stack. And we actually work really hard. I mean, this is like, we're skipping ahead here. We actually work really hard to not do stuff that Xero does. Like we have like a crypto P&L, but we don't have like a full P&L. Like
that's it. Xero is just the general ledger and build on it.
Exactly.
Before we get into the tooling though, Pat, what we really need to know is the crypto business trends, like what is happening overseas that we're likely to see here. As I mentioned, I think some of our clients don't tell us they're using crypto in their business, or they might be thinking of business models that we don't understand. So if we can, know a bit more about what you're seeing, it'll help us talk to our clients and find out.
Let's get into it.
Okay.
Yeah, nothing would make me happier.
Okay.
So this is how we're going to kind of set it up on this side. Is we're going to talk about what's new in enterprise and business crypto. To begin with, we have a maturity model that I think could be really interesting to your listeners, which is, we think deeply about, I like to say like day 1, day 10, day 365, and day, I don't know, 720. Like I tend to think about this, like there's that first day kind of, oh crap moment. What the hell are we going to do now? And then there's that moment like a year or two from now, we're like, guys, like this is going really well. Like, how do we actually continue to get better benefits from this? So we have a model that it's a 4-step model that walks you through day 1, day 2, day 3, day 4, well, longer than that, about like what are the different issues are going to come up at all these different points in the maturity of your processes, and then what do you need to be building to handle that? I have a full demo of how we do crypto accounting in Xero. This should be really fun. And then we'll have any questions that come up at the end of it. So looking forward to it. One thing I was going to mention, I threw this slide in here, Electra, for anyone that is interested. I know you're on the other side of the world, but we also have these things called airplanes. So it's a world where it might happen. If any of your clients are coming to Consensus, we're doing a summit called the Enterprise Digital Asset Summit that is just for people like us, people that are working with businesses and digital assets. It is all, accountants, CFOs, people like product managers, everyone who is doing the day-to-day work around this. We do a whole conference here. If anyone's interested, just look up.
We'll try and get an Australian contingent to come to this. That looks really cool.
We'd love to have you. We would love to have you. We'll all do shoeies. That's a thing, right? Okay. So the first thing that I want to talk about that definitely is the biggest trend on everyone's mind is the FASB news that came out last week. So this takes a little bit of explaining, but let's kind of get into it. And this also sort of is a little bit different because I know, depending on if you're following IFRS or US GAAP or UK GAAP, there are different treatments for this. So for you, I believe that I believe you're mostly following IFRS in Australia. Is that right? For the most part. So it's a little bit of a different, so the FASB decision obviously is slightly different and not necessarily 100% applicable, but as with all these types of things, these decisions tend to reverberate, like decisions of the US tend to reverberate around the world pretty.
Australia just waits for instruction. So we're waiting.
Yeah. So this was the big news last week or 2 weeks ago, which was the FASB board voted to begin to basically do an evaluation of digital assets as fair value assets, which is also different than IFRS's treatment. So the traditional treatment under US GAAP is a long-term intangible asset. And I always I honestly like to joke about that because like most people, the long-term intangible asset they deal with most is, I mean, gosh, maybe some contract stuff here and there. Probably everyone has a domain name that they have as a, like in some bucket somewhere on their GL that's a long-term intangible asset. But one of the parts is that, for the US GAAP treatment, you're supposed to do impairment, which is where you basically do a fair market value analysis. And if the price of the asset drops below what you paid for it, you create an impairment expense, and that then gets offset by a realized gain that's going to be bigger than your tax one. Now, the funny part about it is like I can't think of the last time I would have marked down a domain. When we talk to accountants all the time, CPAs, corporate accountants, anything like that, bookkeepers, they almost never impair stuff. It is really pretty random. Like the last domain that was probably impaired was probably enron.com, and that was a while ago. That was like, so it's just not something people do a lot. But with digital assets, because of the way that everything sort of fell in together, is that you did end up having to do an impairment. Now, IFRS was so US GAAP said you had to do impairment, which was a mark down with no mark back up, right? So it's an important difference between IFRS and US GAAP is you couldn't do a reclamation or a recovery of the impairment. Once you marked it down, you changed your carrying value permanently to that, and then when you sold it, you didn't do a contra impairment expense, or in that case revenue. You would pick up the difference between your impairment expense would go into the realized gain. And so that meant, like, it was one of those things. The reason this is such a big deal, there's a lot of reasons it's a big deal. One is it made it complicated, which for someone like us who had an impairment module, that's fine. We like the complexity there. But the bigger issue is I tend to think about someone like the CFO of General Electric, or like someone who is probably like the number one or number two most powerful person at the company. Like a company like GE that does quarterly earnings reports and is very beholden to the markets. Their CFO is a very important person at that company. Like he calls a lot of shots. So if you come to him and you say, all right, Mr. CFO, Mrs. CFO, there's like, we're gonna buy this asset, and there's a chance, not for sure, but there's a chance that you might have to take randomly a $250 million loss one of these quarters between now and whenever we decide to sell it, like, which is what happened with Tesla. Like they picked up a $250 million impairment expense. The CFO of GE is gonna be like, well, you're out of your mind. Like, please leave my office. I'm never gonna do this. But of course, with this move to fair value, that is now changing. Now, there's a lot of nuance to what sort of happened in here. Like the actual judgment hasn't, like the full vote hasn't come out. They haven't written any guidance, all this different stuff. They put a lot of carve outs in this as well. So they actually carved out really explicitly. They said, like, this does not cover where there's a guarantee to underlying rights or assets. So they actually carved out things like Pax Gold, USDC, a lot of securitized tokens got carved out of this. A lot of governance tokens, which have guaranteed rights to underlying services like voting, might have also gotten carved out. But I think the goal was really that Bitcoin, Ethereum, those seemed very, very squarely in the purview here. So I think if this does reverberate to IFRS, because even in IFRS, you would do the exact same treatment, but you could do a reclamation revenue event. So you wouldn't do contra impairment, you would do a recovery event that would be a profit in that sense. So you could more accurately kind of show your digital assets on your balance sheet, versus America, where that sort of impaired cost basis just meant that Bitcoin looked like a very, very undervalued part of your balance sheet, and it kind of like triggered people to not correctly evaluate their balance sheets. With fair value, obviously, it's totally different. You're going to be doing a mark to market on a monthly basis, picking up the P&L on that directly on the gain loss. So it's a lot simpler, a lot more fun on that. But you might still have to do other impairment on other assets outside of it, depending on how it all shakes out.
Well,
so
as these new accounting standards come through, it will be interesting to see how that affects our institutional adoption of digital assets too. So
my high level theory here, and this is, look, always take any crypto person you talk to, take it all with a grain of salt, because we're always bullish. It could be the worst bear market of the entire universe, and we're like, but like, this is bullish for crypto. This is bullish for crypto because you take kind of this FASB decision and you overlay the merge that just happened. Yeah. And the combination of those two, again, I think about that CFO from GE, and I don't know why. I don't know who it is. I have no idea. I have nothing about this person. But like, suddenly their ESG goals that they have, because GE has like these really aggressive ESG goals, their ESG goals, their CFO or finance goals, and their product goals or their financial services goals all suddenly align, because it's a lot like Ethereum is suddenly a much more sustainable blockchain. You suddenly have a much more friendly treatment, and the product team's already been clamoring for this. Like Ally, whoever that like reports up there already wants this stuff. So you suddenly have this alignment. Like I tend to think this is really going to be good for enterprise adoption here. But that's, that's just me.
I agree. Okay.
So that's it there. And I will say, I love to think about, one of the ways that I tend to think about the world of crypto, because I've been in this for a long time now. I like to think of every year has a theme with crypto. And like, I kind of like to think of like the summer of XYZ, because for whatever reason, crypto always goes nuts in the summer. And so like, when I first got into well, like 2020 during the pandemic, it was the summer of DeFi. I don't know if you remember this, but everybody in the world, all they could talk about was DeFi, DeFi this, DeFi that. It was all about DeFi. 2021 was a summer of NFTs, right? Same thing. Like nothing else in the world existed except for Bored Apes and that. Like that's all we talk about was NFTs. 2022 was the summer of winter. The only thing anyone could talk about was the crypto winter, and that was the end all be all trend, and nothing else really mattered. 2023 for me is going to be about tokenization. So my proof point here is, KKR just made their big announcement, which is all about tokenizing their part of their portfolio. Like I think they were going to tokenize a $4 billion part of their portfolio, which is it's like 1% of their portfolio. It's insane. The numbers of this stuff is all insane. But we work with customers that are tokenizing real estate. 2 weeks ago, Roofstock sold a house on OpenSea. They sold an NFT representation of a house on OpenSea that you bought it. You owned a house in Columbia, South Carolina. So that, to me, that's going to be the trend of this, is by the end of 2023, this is, all disclaimers apply. I think you'll be able to buy pretty much anything you want on the blockchain, from Tesla to Microsoft stock to private company stock to real estate to, boats, whatever it is you want. Wine, like we know somebody who's working on a really cool wine project to tokenize vineyards. All of that will end up on the blockchain, and it's going to represent a phenomenal new way of fundraising for entrepreneurs and inventors and creators, and a phenomenal headache for those of us that do the accounting for them, because boy, this is hard, right?
So this would really hit us big time if our clients with existing businesses start looking at what they've got, what they can
yeah,
what they can tokenize.
What could I possibly tokenize?
They could be tokenizing services.
Tokenizing services, all of it. So then you end up in a situation, and I'll apologize because I'm a little bit, I don't know a lot of the IFRS lingo for some of this, but you end up in like an ASC 606 analysis or an ASC 815 analysis, which is either looking at how, like you're looking at very complex revenue recognition treatments, deferred revenue recognition, all that, or you're looking at very complex derivative treatments. Like this is a derivative asset of some sort of underlying asset, and you have to do a full 815 analysis, decide if, which one you're pricing, where you get pricing valuation from. I mean, it just gets more and more complicated as we kind of go through it. But that's sort of the fun part. I mean, that's why we do this. This is all super fun. Oh yeah, luxury goods. You could buy a Rolex on the blockchain right now, and then they'll hold the Rolex in a warehouse for you until you go and claim it. That's pretty fun. I don't know. It's sort of this idea.
It's all about ownership. It's the ownership economy, isn't it? I mean, staking our claim, our ownership on things in a digital format.
Yep. Which is, and the idea that you could like take that Rolex and you put it on your avatar, and then you take it and you trade it in, and then you wear it, and then maybe you give it back and put it back on your avatar. This idea of how do you like transcend into these different virtual worlds?
Rent it to someone, they can borrow it, they can pay you a fee. Okay.
Well, I mean, the borrowing of all this is, I mean, borrowing NFTs with using them as collateral, all that is super interesting. Yeah. I don't think we won't spend a lot of time because we're going to run out of time to do NFT
I can talk to you for 2 hours, Pat.
Oh, easily. We'll do another one where we just talk about NFT valuations and pricing.
Yeah, let's do that in the new year. All righty.
All right, perfect. Okay. So this is what I want to talk about, the digital asset maturity model about. And so the goal of this isn't that you don't have to understand every single thing that gets like laid out here. But the goal is to start putting some guide rails in your brain about how to think about this and how to think about it with, and how to talk about it with your clients, your business partners, whoever it is you're out there. It's meant to go from this like level 1 through level 4. Level 1 is someone at your company just like out of a fever dream bought a bunch of crypto on their American Express card, and you suddenly have to deal with that nonsense. Like what are you possibly doing at that point? You have no idea, you have no controls, you have one person with all of it. Level 2 is this idea that you start to expand. You're like, hey, this is actually pretty cool. I can, start to create smart contracts. I could token, like you start to expand that. You have more people touching the digital assets. So like level 1 is all about figuring out, getting your feet under you. Level 2 is about scaling. Level 3 tends to be about controls, because at this point you have a lot of wallets, you have a lot of transactions, like a lot of stuff is going on out there. How are we actually dealing with it? And then level 4 is saying, okay, well, we've become masters. Now, how do we take this and put it to our advantage? So we'll kind of walk through each of these at one step here. But level 1 maturity to me is, you have, like, someone just bought a bunch of crypto in your organization and you need to kind of deal with it. We talk about, you want to assemble a team. Now, the team might just be you. And I hope that's if you're doing bookkeeping as an outsourced bookkeeper, if you're an accountant at a company doing this, one of the parts that's super important about crypto, if you take nothing away from this webinar except this one single phrase, this is the only thing that matters. Every single crypto transaction is an accountable transaction and a taxable transaction. So the biggest issues that we see are when one side of that or the other decides not to incorporate or talk to the other side. So you have a tax team that says, hey, we need to be able to handle crypto, but they're like, oh, we don't really care about the accountants. Or you have an accounting team that says, hey, we need to be able to handle crypto. Screw those tax people, they'll figure it out themselves. And honestly, like, the world that we live in is kind of arranged that way. We are oftentimes, accountants and tax folks are arm's length away from each other. They are, the only time at a big business, the only time they'll interact is like once a month. You'll send your tax, you as the corporate accountant will send your tax people a couple of like workbooks or something like that, and that's it. You can't do that with crypto. You cannot have a separation between your accounting and tax people. It will lead to so much pain on the other side. So when we say tap a team, it's not that we're saying that you have to identify a team and give them all, special shirts and things like that. It's that, like, when you bring digital assets on your balance sheet, it is impacting the controller's office, the tax office, the treasurer's office, the FP&A office, depending on the size of your organization. All of those folks should have someone that's in the conversation from essentially day one. Now, the treasurer and those guys might not care because it's de minimis, it's not material. Tax and accounting certainly do. So the day one team might just be you and your tax team and your accountants. But you need to get that going early on, and you need to create those channels of communication early on. That's a really, really important thing. And what you want to do is you want to start getting them trained up. I mean, there's no other way to say it. Like, crypto is one of those things you can't talk about in the abstract. Like, in the abstract, crypto is magic internet money. Like, that's not a thing you can describe to accountants. Like, what you have to do, and this is something that, like, we do with when we're onboarding people, we'll do an onboarding training where we actually bring 100 people together. We get a Solana wallet. We send them all crypto. You can send 5 cents of Solana for nothing. So I can send everyone 5 cents of Solana. I then have them go into a liquidity pool or buy an NFT or whatever it is. Like, you have to train them, and you have to get them using it. Even if it's all throwaway money, it doesn't matter. Like, the only way you get this stuff is touching it. You can't think about this stuff in the abstract. It's way too hard. So step one, get your team together and begin to understand the rules. Begin to, come to find a product like Bitwave or whatever it is, to begin to understand, like, what the actual accounting rules are. This is the one stage where I kind of joke, like, you probably can do it on spreadsheets at this point. And we actually do have customers that, like, at this point, they'll do the work on a spreadsheet, because you buy one Bitcoin and hold it for a year and then sell it. You don't need Bitwave. You don't need any product. Like, save yourself the heartache. Like, just use a spreadsheet, make your life easy. But you have to understand it, right? Use that spreadsheet, write your impairment docs. I mean, honestly, like, the day you decide to go and try to write an impairment, because the way you do impairment on crypto is day by day. You do a daily test. So the day you decide to go write an impairment worksheet, you'll decide maybe you do want a product in your life. But, like, if you're doing it all by hand at this point, that's totally fine, because you're learning the ins and outs so that you then know how to, like, how to evaluate a product and get into it there.
Like doing a ledger, you just got to think it through sometimes.
You just gotta think it through right now. So that's what we say is, like, find where you're getting your balances, find where you're getting your transactions, start to build up integrations between your general ledger and your system there, and then make sure you're thinking about your audits. Like, if you get audited, make sure you talk to your auditors about what are the stuff they're going to be looking for, because they have to audit this stuff, and the more work you make them do, the more expensive your audit is. So you really want to make it as easy on them as possible. So you then want to design up a ledger. This is where things get really, really interesting. We tend to recommend people do a single general ledger account. Now, we can talk about that. It's a really interesting conversation to have. But the high level of that, there's sort of three ways that you can think about your general ledger when it comes to digital assets, right? So one is a single digital asset account that's, that is a primary ledger account of a sub ledger that you're keeping somewhere else. Two, you could separate your digital assets by asset type, Bitcoin, ETH, cash equivalents, things like that. Third, you could do it by wallet. So I could have my spending wallet, my developer wallet, all that kind of stuff. What people don't tend to think about crypto, especially at this stage, that early on stage where you're designing this stuff out, is transaction volume in crypto is unlike anything else you're kind of used to. We have customers that regularly are doing 40 million transactions a month without breaking a sweat. And these are 12-month-old companies that are doing this kind of volume. If you get to the point where you're doing that around that kind of volume, you already are going to be doing some sort of roll up or something like that. So you already don't necessarily want to have you want to have a system where all the detail is, and then your general ledger where you just get the kind of roll up results into. But then even that, wallets at crypto companies tend to proliferate like things that proliferate very rapidly. It is incredibly easy. While I'm on this call, if I wanted to right now, I could make 15 wallets like really, really, really quickly. I could just make 15 wallets immediately.
And look, you can, if you're designing, if you've got an ENS domain and you start building out a chart of accounts based on subdomains of that, like it could get, I've never seen someone say just create a primary ledger account, because I'm hearing from you now that you could end up with a 4-page balance sheet.
Happens all the time. Like we have customers like, we really want this. Then a year later, when their developers have added 50 different wallets or 100 wallets. I mean, we have customers with 30,000 wallets in their organization. That is, you end up in a situation where you just cannot scale that. Gotcha. So wallet by wallet is really tough. It also, when you do wallet by wallet, it also means that you're having to pick up the transfers between them. Yeah. And that's actually really hard from an accounting perspective, right? Because you imagine I get revenue into wallet one. Let's say I get 2 revenue transactions into wallet one. So one's when Bitcoin's at 100, one when it's at 200. So then I move 1 Bitcoin to wallet 2. I am suddenly having to make a very difficult decision about relief strategy between internal transfers, which honestly it's kind of silly. So, and even if you don't do that from a tax perspective, which you'll often see because people bifurcate their tax and accounting strategy, you still are, it's really hard to audit that. Because essentially what you're saying is, imagine every bank transfer you made between, you have 2 bank accounts and you move money between them. Every bank transfer, you had to do some sort of picking strategy to pick the cost basis that you're actually moving, because you don't want to pick up a realized gain or loss. So you actually have to find a coin. You have to say, okay, I'm going to move my $100 coin. So I'm going to do, debit, credit 100, debit 100. I'm moving my $100 coin over there. That's a picking strategy. That's not trivial in any general ledger system. The downside to doing asset by asset, which we see more of. First of all,
you might have Ethereum, Bitcoin, and your separate assets under digital assets as a heading category.
Exactly. The downside to that, it's a little bit more nuanced downside. The first one is it's kind of weird on the balance sheet, to be super honest. There are very few things that you differentiate by asset on the balance sheet. Like if you have a stock portfolio, you would not differentiate Tesla stock versus Microsoft stock on the balance sheet. So it's one of those things that, like, people want to do it from a risk exposure perspective. Like you come in as an accountant, you're like, no, I want on the balance sheet because I want to see my exposure to Bitcoin. I want to see my exposure. But like, there are a lot of ways to see risk exposure, and there's a lot of better ways to see risk exposure than the balance sheet. In fact, the balance sheet is the worst possible way to see risk exposure because it doesn't show you, unrealized gains and all these other kinds of things. So one downside is that, like, it's kind of different than other of the part of the balance sheet that you look at. The other downside is that it means every trade has to hit your balance sheet. So if you're capitalizing fees, which most of our clients do, although that might change in the new FASB, if you're capitalizing fees and you have a single digital asset account on your balance sheet, trades don't hit the balance sheet, which is basically because a trade is a cost basis movement with the capitalization of the fee. So it's net neutral to the balance sheet. If I take that $100 Bitcoin and buy $100 of ETH with it, that's net neutral on the balance sheet. So a system like ours can hold all the trades. Your balance sheet does not need to have every trade. And honestly, like, trades are kind of a pain in the neck because it is the exact same thing, right? is that like I'm selling my $100 Bitcoin and I'm buying $100 ETH. So I, as part of my balance sheet operation, I have to know to relieve a $100 Bitcoin debit gain loss as well to sort of true that up and then push that all into the other account. It is really hard to audit. Like it is really, really hard to audit all that kind of stuff. So that's why we tend to recommend a single digital asset account and then a really powerful subledger that can handle everything beneath it. But everyone will have different constraints, different reasons they have to make different decisions on that side. Finally, at step one here, the single most important thing you do is you need to establish all these workflows for the bookkeeping. Whether you're using something like Bitwave or you're doing this on a spreadsheet or you're using whatever it is, you have to establish these processes now. So like this is, you don't have to close the books every day, but what you do want to do your categorization every day. People, I'm sure you've talked about this before. People are under the I'm going to steal your analogy, by the way, which is the book, the shoebox of receipts. Like crypto is a shoebox of receipts that's been run through a shredder. Like if someone gives you an Ethereum address, it's worse than a shoebox of receipts, because at least a shoebox of receipts, you can see the McDonald's receipts with a ketchup stain on it. You're like, oh, this was a travel meal. I know what this was. Crypto doesn't have that. Like crypto, you are on your own unless you are following really good practices here. So a lot of what we talk about this is start to think about something called wallet hygiene. It's probably the most important thing that we talk about, which is this idea that you want to segregate usage by wallet. It's not something that comes natural. In the same way that, people don't think about having one bank account. Well, I guess you will often have like an AR bank account versus like your normal payroll bank account. It's kind of like that, which is you have a wallet that you use for marketing expenses, have a wallet used to pay contractors, have your AR wallet for customer A, your AR wallet for customer B. That having it set up that way makes your life super, super easy. Like with Bitwave, you can then basically set up a single rule that auto categorizes all this stuff coming in a particular wallet. This is where you're doing that work. This is where the bookkeeper, the accountant, the corporate accountant, the outsourcer, the advisor, you can kind of still meld the process. At some point, the horse is so out of the cage or the barn that it doesn't matter. Like you just kind of throw up your hands and move on. But at this point, you can shape these things. You can start to write, you can write guidelines, you can write workflows, you can do all this stuff. So really spend time working through that here. This is the one I'm going to spend the most time on because this is the most important thing. This is step one of all this stuff. I'll spend a little bit less time on the next few steps. Electra, any questions on this?
Keep going. We're absorbing. This is great. Thanks.
All right. Spectacular. Okay. So let's then go through the next few levels here, and I'll make sure to save 15 minutes for a demo and all that kind of stuff. So level 2 is where we've gotten past this. Like we know our workflow, we know how to capture these transactions, we know what our advisors are giving us details with. At level 2 is when you start to see that proliferation of wallets. So this is where if you are actually starting to see a real usage of crypto at your company, you are very, very quickly going to go from 2 or 3 wallets to 100 wallets overnight. And so that presents a really interesting bookkeeping challenge or an accounting challenge. There's not that many times, like how often is a bank account open that no one tells you about? Like it doesn't happen. I mean, maybe once in your career or something. Like it just doesn't happen where your client opens a bank account and forgets to tell their bookkeeper about it.
They do.
Okay. All right. All the time.
Now we have to ask them, have you opened any new crypto wallets as well?
Exactly. So in the crypto world, this happens continuously. And to the point, like I can tell you on a weekly basis, at least like one of these days we'll actually do the stats for it. I bet at least $1 million in crypto from one of our clients gets discovered in a wallet that they had forgotten about, that their company had forgotten about on a weekly basis. Last week, one of our clients found a wallet with $5 million in it that they had completely forgotten about. That was just sitting out there with $5 million of ETH on it. This happens all the time. So as part of the workflows you started to define in level 1, at level 2, you want to start setting up business processes. So it's not just workflows, it's not workflows and closing sheets, stuff like that. It is business processes for how you discover new addresses, how the product team or the trading team or whoever it is that's actually playing with crypto, how it is that they tell you as the bookkeeper about a new wallet, a new thing that came up, whatever it is. How do you get that information? So you're starting to build these business processes. You're also getting ready to scale because at this point you're going from 10 transactions to 100, 1,000 transactions. at this point, you really do need software, because like that's where you really, there's sort of two dimensions where you need to get software. There's a certain volume, there's maybe three. There's a certain complexity. So if you have to do impairment, you definitely want software. You don't want to do that yourself. We know one of the public companies we work with, that before they worked with Bitwave, they literally had a full-time person who just managed their impairment worksheet, because that is how hard it is to do these worksheets. I mean, they are really complicated. So if you need to do impairment or anything like that, definitely come to someone like come to Bitwave. The second one is, if as you start to scale the number of transactions, so you get to 10,000 transactions a month, you don't want to be doing that by hand. You want to have that automated. You want to have rules engines around it. You want to have it automatically going out to the different chains, all that kind of stuff. The third is if you get to a certain number of different tokens. So obviously, like each token requires one workbook from your perspective, because it's one FIFO inventory, all that kind of stuff. If you get to the point where you have 10, 15, 20 tokens, which clients get to very, very quickly, that's where you start wanting to really get into software like ours. So it's at this level too that you absolutely need software, because you have lots of tokens, lots of wallets, lots of different blockchains, or you have more complicated requirements. Level 3 here is when things start to get fun. And I like to think about this in terms of the first two levels, a lot of it, and even the third level here, a lot of it is around, there's this funny story, which I think has been debunked, but you know what like why let a funny story that's been debunked go to waste? There was a story about a car, like in the early 1900s, when cars first hit the road, where the designer of the car put like a horse's head on the front of the car, like a stuffed horse's head. And the idea was to make the car more comfortable for the horses on the road, and to make the car more comfortable for the person driving it. Because it's like, look at, this is just it's just a horse without hooves, or like, and hey, Mr. Horse, this is just a horse. And I feel like there's this part of the first like couple of levels here where you're taking your current business processes and you're just adapting them to crypto. Like it's that horse's head phase where you're just saying like, hey, wouldn't it be fun if we pay a bill with Ethereum? Like, let's see what happens there. And it's fun, and you do it, and it's all good. Level 3 and level 4 is when you start to get to this world of asking the question, which is like, hey, if I have an API for money, how does that change my business? So this is like, let's take like OpenSea is a great example. OpenSea is a customer of ours. They're an NFT marketplace, really, really cool company. If they were going to, they are a marketplace where the users pay the fees, and as part of paying the fees, they actually automatically get some money deposited into their bank account. So imagine a marketplace where you have no control over the volume, you have no control over how much revenue you're getting, you have no control over pretty much anything. It's just sort of like people are actually on your side, and you just get revenue deposited into your account. That is one of those questions where like, well, at that point, you are privy to the whims of your clients in terms of scale, in terms of complexity, in terms of the tokens you're getting. Like they don't, on the way OpenSea works is that I can sell an NFT for any token. Like I could take a Bored Ape and I could sell it for Uni token, and they let you do that. And then OpenSea takes a cut of that. So that means that they might take a cut of Uni, even if their CFO says, we never want to hold Uni on our books. And so your business model at this point is starting to change. You're changing from like, what's a Web 2 way playing with crypto? It's like, what is the Web 3 world and how are we adapting it? Transaction volume goes through the roof here. You absolutely cannot manage it manually at this point. You need software. You probably need to start doing roll-ups. You need to think very deeply about all the different treatment options.
So I'm just thinking about transactions to streaming here. That's what we're talking about, just constant stream of micro payments. And
exactly. Yeah. I mean, 40, 50 million a year. And you even get to this point, like there's other things that are happening. There are people doing streaming payroll you can go.
It's not like a fortnightly paycheck. It's actual just constantly being paid every minute that you're working virtually. Is that
exactly? Yeah. And so there, this is the Web3 way of thinking about payroll. Like if we had always had crypto, we never would have done, as you say, fortnightly. I love the word. We never get to use it in America, but I get to use it. Like we never would have done fortnightly payroll. We would have done this streaming payroll because it's sort of friendlier for everybody all around. And so we're going to see more and more stuff like that, which is things you could not do with traditional finance that we can do with crypto. So you have to, like, that's your business now adopting into those needs. Level 4, the easiest way to talk about it is everything we talked about so far plus DeFi. So DeFi is this idea that, we haven't talked about too much, but is this idea that, and by the way, depending on your user, they might get into DeFi at any one of these levels, but it is a very sophisticated from the accounting perspective. DeFi is the way I like to describe it, if you're not familiar with the term, is imagine any single financial operation you could do through your bank, but now you do it through the blockchain. So let's take, I want to borrow money, I want to lend money, I want to issue debt onto the blockchain, I want to create a collateralized debt obligation, I want to buy insurance as to whether or not it's snowing in Tahoe on November 1st. All of those things you would have done through an investment banker, through some sort of banker. Today, you can go on the blockchain and do every single one of those and a million more directly. Like there is you can go into the blockchain today and buy parametric weather insurance, which is crazy. So at this level, like your finance department is changing because you're now, for things that you would normally go to a banker to do, you are doing more and more yourself. You are borrowing money yourself. You are lending money. You're making yield decisions yourself. So your sophistication as a finance organization has to really change. And that means like, the people around you, all that kind of stuff. So that's maturity model. It's bitwave.io/DAMM. Damn, is the place to go and download it. It's a free download. It's super fun. It's a fun read. It's like 25 pages. And it just goes through all these things in a lot more detail and like what you need to be thinking about.
After this session, we'll be studying it for sure. That was great. That was great. What a time to be an accountant. I mean, that's the progression of enterprises getting into crypto and where they could be in a year or two here.
And all the things you have to be evaluating, like what you have to be thinking about for your clients. And honestly, I mean, getting back to your earlier question, your earlier point, which was so good. These are the questions you should be asking your clients. So like whether it's you're 6 months into an engagement or you're scoping it, you should ask them like, hey, by the way, have you guys done any DeFi? Hey, by the way, do you have any money in liquidity pools? Hey, have you bought an NFT? Like this is all stuff that might not occur to you to ask, but boy, is it sure important if you're trying to do the questions here. Okay. So we're going to do a really, really quick demo here. We only have about 10 minutes, so I won't belabor this. We'll leave some time for questions and all that kind of stuff. So this is Bitwave. It is designed to feel, I always say this, I designed a lot of the interface, so I say this with love, is designed to feel familiar to accountants, which is to say it's not the sexiest interface. It's the interface that we all want from an accounting tool. Like you want something that's very usable, makes you feel comfortable, all that kind of stuff.
We don't like our software looking like social media. We like it being simple and industrial and compact.
I always say that. I'm like, there's, you come to Bitwave, you're not going to get any dancing monkeys in the UI. Maybe someday, I don't know. We have our little surfer here, but that's just showing that this is our fall release and we have lots of fun new features. But that's all the fun that you get from it. Bitwave works exactly you expect. You come in, you put in your Ethereum addresses, your Ethereum addresses, your Bitcoin addresses, your Matic addresses, all that kind of stuff goes into Bitwave. We can do there's some treasury management stuff here that, like, one thing to always keep in mind about crypto that's so different is that crypto, you always have a current balance to get at. Remember in QuickBooks, the balance that you see from the bank is not really up to date second by second. Like it's based on when they're syncing it, there's issues that can happen. The way that we show this portfolio here, this is your current holdings on the blockchain at this second in time. So this is like as up to date as you possibly can get for what your balances are. But where you really are going to spend the vast majority of your time is in your the transactions view here. So we call this kind of our transaction register, or it's sort of a crypto transaction register. What I'll say first and foremost is that crypto transactions are not like normal bank transactions. I know that's an incredibly stupid thing to say, but it is. There's two things I want to show you here to kind of get you thinking about that. So this one here is where I paid a fee and then I sent a different token. So it is one single transaction on the Polygon network that has two different tokens associated with it. The reason this is really important, okay, is that you need to be able to represent this in your general ledger, and you don't want this to really be two journal entries. Well, I mean, it ends up as two journal entries. Obviously, you don't want it to be two transactions in your GL, because you could do this if you do this with, this is going to get, I'm couching how we tend to set up our Bitwave account in Zero. With specifically, we tend to set up our Zero account as a bank account. which might seem super unintuitive. And it is. It's not how we want to do it. Because this is not a cash equivalent. This should not be at the top of your balance sheet. But the issue with Xero and a lot of the general ledgers out there is with most of the different asset accounts, it's really hard to represent one single transaction that has two different components, a fee component and then a expense component. Or even more complicated, something like this, where I pay a fee to reclaim some revenue. This is incredibly common in crypto, where you are going to have a single transaction that underneath it actually has a fee and revenue. That's not a normal transaction in the normal world. So this is why we tend to set this up as a bank account, because you can model these things in a bank account in crypto, in Xero in particular. You can actually model these things really, really nicely in that bank account. So you can add multiple lines, you can have all those different things. So this is why we tend to use a bank account instead of one of the other digital asset accounts. It is not right, don't get me wrong. A lot of our clients do a reclass at the end of the period into like lower in the balance sheet. If you're using something like NetSuite, you can actually move the bank account around the balance sheet, so it's a little bit easier.
It feels so wrong, spend and receive money, but yeah, I see we came back to it. Yeah.
Yep, it's where you end up because you have to. So
Yeah.
what I'm gonna do is I'm just gonna walk you through a really simple transaction here that we have that is a revenue transaction. The high level is that we have this 1.01 ETH that's hitting our wallet here. Now, Bitwave is pretty cool because we can automatically detect movements between wallets. So if this ETH was a transfer from another wallet, if I go up here to the to view all of my transactions, not just the reconciled ones, you'll see that we detect when you move ETH between wallets here. So if I move ETH between my wallets, like I'm doing right here. So this is where I'm moving ETH from my Trezor wallet. I move this much ETH to my trading wallet, this much ETH. This is obviously a movement between wallets. So we can detect these internal transfers, all that kind of stuff there. So when we see a transaction like this, that is a single revenue event to this wallet, we know that this is net new crypto. And with net new crypto, basically what we're doing is we're going to call it it's one of two things. It's either revenue or it's a cost basis transfer in from a wallet we're not monitoring. But we'll look at the revenue one here. So what we do in Bitwave is we make it really easy, where basically I can come in here, and this is designed to feel like your coding screen in Xero or QuickBooks. We pull in your contact from QuickBooks, Xero, NetSuite, Sage, Workday, wherever it is. So I can come in here and say, okay, this 1.01 ETH was actually sales from our consulting company. So our consulting company, it's sales of product income from them. We suggest an exchange rate. You can override it if you need to. There's a lot of reasons you might need to. There's role-based access control around this if you need that as well. We then kind of multiply it out. So this 1808 exchange rate times the 1.01 ETH turns into this 1835 here. This number is now basically, it's three different things. And this is what's so important to kind of keep in mind. And it's what's kind of cool about a product like Bitwave, because we do this for you. This 1835 is first and foremost your general ledger impact. So when I save this and I reconcile it, it's going to hit Xero QuickBooks just like this. This is a different transaction, but you're going to see some sort of, this is a spend. Let's go to a revenue event on it. You're going to basically see one single invoice coming in, some amount getting paid directly off of it. That's actually hitting that particular transaction for 1835. So this right here is debit digital assets, credit sales of product inventory. Second of all, this is your taxable cost basis. So if you recall back to all of our discussions about impairment, fair value, all of that nonsense, it's the second you're doing fair value, the second you're doing taxes, your accounting and tax books have bifurcated, right? Because you will be keeping a set of books that has the book cost. Under impairment, that's the impaired to cost. Under fair value, it's the current fair value cost, including the unrealized gains and losses. So this is going to become your tax cost basis, which never changes, because I need to track this particular lot of ETH here needs to get tracked forever for 1835. And when I sell it, I need to be disposing of this 1835, not my fair value or anything like that. Third, as I'm sure you've now guessed, you need to be tracking this for the accounting cost basis. So I have my accounting cost basis. When I go and sell this, I will have marked it up, marked it down, marked it up At some point, I'll go and sell this, and whatever the delta between my fair value and this is, that gives us the final number. So general ledger impact, tax impact, US GAAP, IFRS impact, which is then going to be different than the base one.
That brings it together. Quick question, if I may interrupt. Melissa wants to know, does it create a sales invoice or know the sales invoice to pay against?
We allow you to pick up sales invoices. So if you are doing invoices, you can actually come in here and select that this was a payment for the invoice.
So
and then we'll
pulling in your customers from Xero or QuickBooks.
Exactly.
And you're invoicing them from here?
Yeah. So the whole goal of this is getting back to this again. We didn't want to build like a full invoice management system. I mean, Xero, all these things are really cool. That's not what we didn't want to build all that. So you do all your invoicing in Xero. We then pull it up here. This one is kind of a funny one because if you look at it, we're getting $1,835 of payment for a $100 invoice. So then we book that $1,735 into the Forex. So you actually, if you have a Forex account, which this instance doesn't, but you can basically book that directly into your Forex right from here. So there's really cool stuff around there. The other scenario, there's like 4 different scenarios around invoicing in crypto. This will have to, you know what, Electra, this is going to have to be our next one. The 4 different ways to invoice in crypto. The hint is you have like a USD invoice that gets paid in crypto, an AUD invoice gets paid in crypto, a crypto invoice that get paid in AUD, a crypto invoice that get paid in crypto, and then like there's one more that's even like a kind of another side of that. So you actually have a lot of different ways you can do this, and we have a lot of different ways we work with that system here. But I think we are just about getting to time. You know, the things that we didn't get to show off is how we actually calculate the gains and losses, all that sort of stuff. But that can be the next time. If anyone's interested, we are at bitwave.io. Here we are, www.bitwave.io. The internet, the digital asset maturity model at bitwave.io/DAMM. You can also get right from there. And it was really and truly wonderful being on this.
Fantastic, Pat. You have covered so much ground that we've been asking questions about, and your FASB comments were really just the most helpful and clarifying I've heard since they've been talking about impairment. So that was really great. This has been fantastic. I've recorded the session. We're going to make a bit of an article and an ongoing conversation about this, I think, because wow, there's so much more to know.
Yep. And there's the other great question here was Rose. Rose asked a really good question in the chat, which I know since we have just one second left to answer it, which was, do we change our billing model to do per transaction? Which is actually, so we give you 10,000 free transactions a month because we don't really want nickel and dime people. That's enough for most people that we work with. But as a bookkeeper, if you have to do 10,000 transactions a month, that's a lot. The thing I will say to you, Rose, that so first of all, you absolutely should be scoping your engagements based on transaction volume. So like, it's all fun and games. Like, we don't ask people how many wallets you have. I don't care how many wallets you have. You have one wallet with 100 million transactions or 10 wallets with 1 transaction each. That's what really matters. So when you're doing your scoping, that's the place to get really, really serious about this, because the difference between, you know, a person coming in with 1 million transactions, a person coming in with 1 transaction is all the difference in the world. Like, it really is like such an enormous difference. So anyways, yeah, I know it's kind of a funny question and we're all joking, but at the end of the day, like, it's one of the things that we tell our partners, because we work with a lot of outsourced CFOs, CPAs, things like that. When you like, the scoping part of these exercises is incredibly important. Don't take on clients without scoping their workload, and hold them to it. So when they show up, hey, we forgot about this wallet that has 10,000, 1 million transactions in it. You're like, but wait a minute, we have this really clear scoping document that doesn't say that. So this could be more money, you know, all that kind of stuff.
About learning what to scope first. And we did have a scoping, a session that was very much about scoping crypto tax clients. And so this is a new world, and I'm sure we'll have more to learn from you on it. Fantastic.
100%.
Thanks, Pat.
Spectacular.
Thank you so much
for having me.
Bitwave team for being here today and organising this with me. And thank you, Accountants on Chain, for joining us. We'll be sending this recording out to everyone, and give me a little time and I'll write a clarifying article too, and get some feedback from everyone on what you'd like to learn next from Bitwave. All righty.
Thank you so much.
Enjoy your snow.
I
I'll
will.
enjoy
I'm
my
gonna go
time.
play in the snow right now and enjoy your sun.
Have a great day. Thanks, everyone. Bye now.